Good morning, traders. Today is August 13th. We're going to go ahead and go over the chart. Some big news last week. The rotational modeling system, as I alerted you in the middle of the week, had started to roll back into bullish trending. You can see this trigger here on the SPY went long Friday morning off of bullish trending. Very solid buy trigger right now, but we do have some concerns. Let me explain them to you very briefly before we get into the charts. So the SPY is one of the main systems that we run with the rotational modeling system. And I'm going to show you the real value of the rotational modeling system as we go forward. You see these charts every week. Maybe you don't understand them. I read them as trending. So for example, this green is more strong bullish. This is weaker bullish, the light green. Yellow is neutral, meaning kind of neutral bullish. Pink is neutral bearish, meaning it's really going against us. We need to be concerned. And then as we move back into stronger trending, it goes back to green again. Now, the rotational trigger level, which is this yellow dash line for bullish trends, and this pink level down here for bearish trends, and let me spread this out so you can see it. There's the trigger level, is essentially a fractal level. It's more complex than that, but it is a fractal level that is used as a price trigger level for the trend strength indicator, the proprietary quantitative modeling that measures trend strength. Now you would think, well, why didn't we get long back over here? The strength of the rotational modeling system is not picking these short little trends. If you want short little trends, I have other systems that we can focus on to try to capture these short little trends. But if you want to have something that's consistent, that makes money perpetually, year after year after year with moderate drawdowns, then you want to follow the daily and the weekly on the SPY and the other markets that we look at. So what happened last week is that we had the ES move into daily bullish trending back here on Wednesday. You can see these arrows right here. So this told us that, okay, we're starting to get a change in direction. Started warning of tops here, a potential top with these yellow triangles, just like we warned down here. This is extreme selling, potential bottoming location. The blue means extreme potential for bottoming location. We had one here and one here. We have yellow back over here telling us potential topping, and that this would be look out, we need to protect ourselves, so we're short potentially. Now we've gone back into green trending here. This tells us we're back into bullish trending. The YM did the same thing. The YM rolled into bullish trending back over here on Wednesday. After a couple of weakening signals, topping signals, we're now back into bullish trending. This is a fairly strong indicator that value stocks are performing. The S&P, the Dow Jones, the transportation index are performing. The Nasdaq is not performing. The Nasdaq continues to stay bearish with the rotational modeling system. You can see here it is weaker in yellow trending here. And the rotational modeling system trigger level is coming downward. You can see the rotational modeling system trigger here had come downward and is starting to incrementally move a little bit higher. But what we're going to see here potentially next week, depending on what the Nasdaq does, we could see this move into bullish trending early next week or the following week, depending on what happens here. We are very close to moving back into bullish trending. So that's why I'm advising this week that we take this trigger where value stocks seem to be performing very well and growth stocks are not at the moment. We are going to attempt to leg into or incrementally leg into this new bullish trigger simply because we're not getting a broad move. And the Nasdaq, technology, biotech, healthcare are still rather large with regard to how they can move markets. So we need to see how this plays out. And if we wait a week or two to get fully into a long position during or through this incremental transitioning phase, we're going to be fine. We're going to be absolutely fine going forward. So now let's come back over to the 401k and deployment mode. The rotational modeling system is starting to shift back into bullish trending. I'm increasing the stock allocation to 25%, but warning all members to stay cautious and use stops right now. I just explained that to you. A divergent price trend is setting up with RSI that represents moderate risk for the U.S. stocks going forward. If the U.S. markets continue higher, we will incrementally modify our allocation levels higher. So what we've done right now, because the Nasdaq is still bearish, we've moved our short-term trigger into moderate bullish, and we moved our long-term trigger into moderate bullish, which has been here for many weeks. Our stock levels have increased from 10% to 25. We took 25 or 15% off of our cash position, reallocated it into the SPY and value stocks based on what we're seeing with the rotational modeling system. Our metals position stays at 25%. We see metals are holding up off of that last capitulation bottom, starting to rally higher. I'll show you the charts here in a minute. And bonds are keeping at 20%. Now, bonds we may move out of depending on how the rally phase takes place going forward. We got into bonds, we increased by 10% about 3-4 weeks ago. Now we need to really start to pay attention. If the dollar continues to move lower, the stocks continue to move higher, we may incrementally move out of our bonds position here and move that back into cash because we don't want to be holding bonds. It acts as a negative if the dollar moves lower. But we don't have really any confirmation of that yet as well. Okay, our alternate position is 35% stocks. Remember, value stocks seem to be performing as the Nasdaq has yet to convert into bullish trending. So we're really seeing strength in value, not growth, not technology, not healthcare. We're seeing the hunt for dividends and the hunt for value, not growth. We have a 50% cash position and a 15% bond position. So 40-50, that is correct. Now, if we come back over to the trend direction, we just went through most of this. You can see the ES, YM, Indu, transports, and SPY are all short-term bullish, long-term bullish. The Nasdaq is short-term bullish or bearish, long-term bearish. This is the one that is now showing the risk factors still exist for growth. Now, this could change next week depending on what happens or the week after. But generally, we're seeing value trend higher, whereas growth, technology, healthcare, biotech is still moderately weak and hasn't changed direction yet. Gold and silver are still long-term, short-term bearish, even though we've seen the capitulation bottom, as I mentioned, and oil is mixed. Remember last week I told you oil's likely to continue to move lower. We saw it move down to about $88, a little below 88, I believe, and then closed back up around 91, I believe, last week. Oil's really seeking some sort of an intermediate support, and I think it's going to be found somewhere around 85, 86. It could move down into $76, $78 area on some sort of moderate downward trending, which could come as the end of summer is hitting us, and consume high price gasoline is causing some people, for example, I know certain of my family members have canceled their summer trips, or they would normally be taking summertime breaks and driving around, visiting parks or going to the ocean. A lot of people have actually stopped driving and are doing other things, finding things to do around their house, local parks, what have you. So oil, I think demand is going to continue to weaken, particularly if we see other COVID issues in China or economic concerns globally. You could see that a global demand for oil actually weakens, and that could be something that we're just not factoring into right now. Okay, so now let's take a look at the FANGs index, which shows the divergence. This is a stochastics divergence. You can see rising stochastic peaks here now, while we see a weakening price trend. This is the Nasdaq. This shows us ideally that this rally phase could weaken, almost immediately within a couple of days or a couple of weeks after getting up near, maybe up near this 180 level, maybe just a little bit higher, back retesting this high level. This shows us that we have a divergent price trend setting up after this downward move. And I want you to also understand that this represents leg one moving downward right now. We do not have any initiation of a leg, another leg down. So what we have right now is an A, B, C wave down. So this represents wave one to this level. Wave two potentially could correct up to this level, still be valid, or this level, or this level, or technically even get right back up here to this high, forming a double top, and still be a valid leg one down, followed by a leg two upward correction. So we need to be very cautious. We could still be in a downtrend, having a bullish pullback in a downtrend. Markets could rally 15, 20, 30% at this point, stall out over here before moving lower. Okay, so this is why we need to stay cautious. We have opportunity, but it could roll over at any point going forward. Right now, the next level, because we've gotten above this level, this 50% level, the next level is going to come right in here, which is about 161, 180. It's about 11% higher than where we are right now, 10 or 11% higher on the Nasdaq and the FANGs index. With the US stock market index, the divergent trend in this yellow line is actually clearer. You can see the RSI new highs back over here. We've got new highs on Stochastic here as well. You can see the downward price trend here between this high and this high. This is called technical divergence. And we still have that same setup. We still have that A, B, C trend, meaning that we could come all the way back up to previous highs or over in this area or this trend, and still see it roll over, meaning we have somewhere between maybe 5.5 to maybe 10% higher, and we could see it roll over and still constitute an A, B trend, starting a massive leg down for C. So we need to be very cautious here. We have some opportunity, but we could still see a deeper rollover, some sort of a global contagion event, or something unraveling the markets. Maybe the Fed, maybe foreign market banks. Who knows? We're in a decidedly different market right now, so we're not in a broad market recovery with the Fed printing money and government handing out stimuluses. We're in a weaker trend. The government just passed the Inflation Reduction Act. I think what we need to do here, ladies and gentlemen, is let this play out, see what's really going to happen here. Another spending wave could prompt us back up in this area and then potentially roll back over depending on what happens worldwide. Next, we have the Smart Cash Index, and this actually shows us what's going on throughout the world. You can see the world is tightening, trending downward. Yes, the U.S. government spending is going to prompt potentially some sort of a rally phase, but we now have this high and this high to watch out for. Really, I think if we see any type of an upward movement in the global markets, which is Europe and Japan and China, it's going to stall back out over here unless they all attempt to move back into some sort of easing. But inflation's going to prevent that from happening, in my opinion. So we need to stay cautious, is what I'm trying to tell you. Gold is starting to act as a real hedge. You can see we talked about this last week after COVID, how it rallied back up, tried to get back up to recent highs, and then started to really accelerate. I'm thinking it's going to be kind of the same thing. It's going to move back up into this yellow channel, which means gold's going to probably move to around 1950, 1940, stall out a little bit over in this area, and then attempt to move back up above 2000, which will put us near these above these recent highs. You can see we're holding up down here. This is a beautiful capitulation bottom. Now we need to see some real follow through in gold and silver and miners to really propel this higher. Next, we have the valuations index, which is giving us a new warning sign. We are seeing some strength. We have seen the strength in the value stocks start to move a little higher over the past 6 or 7 weeks. But you can see we've stalled out over here. We've got a lot of consolidation. The RSI is still trending downward, whereas Stochastics has moved higher, peaked, and actually crossed downward here. This is showing us essentially that we're not seeing a big broad market rally. We're seeing a very isolated value market rally and we're seeing some meme stocks and some other stocks rally, but we're not seeing real broad market upward bullish movement here. We're not seeing real growth. We are near the upper boundary. Remember, this is historically the upper boundary, right around this 80, 84 area for growth. So we will see what happens as this plays out over the next 4 or 5 months. Remember, we're transitioning into the early Christmas rally phase as well. So we need to see potentially some strength to the upside, potentially maybe another 10, 11, 12% to the upside in US markets. But then we need to be very, very cautious of what comes around wintertime with consumer spending, commodity prices, inflation, what the Fed's going to do, global central banks. It's a totally different market. In reality, after 2021 and after COVID, this is a totally different market than the general market trends that we had seen over the past 8, 9, 10 years. Okay, the commodity gold index moved higher, mostly because lumber had moved higher. And gold is rallying, as you're aware. The dollar is moving lower, as you're probably aware. We're seeing this commodity gold index really consolidate below the 2.4, 2.5 area. And that tells me that we're really not seeing a lot of broad consumer demand. There's been a lot of news out of Canada, housing market collapses. We obviously know what's going on in China with their real estate market. The US markets are a little bit immune from this. I'll show you the real estate chart here in a minute, but I think we're kind of overdue for kind of a let's call it a slow meltdown. Think of it as an ice cream cone left out on the street. It's just really going to slowly melt down into kind of a mess, especially if the Fed is pushed to raise rates by another full percentage point, which would be 100 basis points or more before the end of the year. I think that will curtail U.S. housing market activity by another 40 or 50%, and really put some pricing pressure on U.S. markets. If not, I'm concerned about global investment in U.S. markets. If we see something break globally, some sort of a global financial crisis originate in China or Europe or wherever, then that could spill over into our markets, I would think, fairly easily. So understand what I'm expecting is this to continue to melt sideways and downward through the end of this year, into next year. So we have the volatility index last. Volatility index broke above this level. And you can see here this upward channel here that we've got, this extended channel from these areas, actually from these areas here. What I want you to be aware of is these are typically fairly toppy areas in the market over the past year, roughly, from back over in this October, November area. So when we get above this level here, this magenta level, you can see it's toppy, rolls down, toppy, rolls down, toppy, rolls down. Had a little bit of strength here in September. That was really kind of like the peak rally, end of the year. So then that's the Christmas rally, and then rolled downward. We may see something like that go on over the next couple of weeks and months. We may see it toppy, rolling around this area, 11, 12, 13, as it tries to move higher. But be prepared. We have not moved into upward trending yet. Well, let me rephrase that. This 11.74 is technically bullish trending. 11 to 12 is moderate bullish trending. But we haven't seen it break out of this downward cycle yet, which is why we could be in early stage bullish trending, and we're going to follow the rotational modeling system trigger. But there's a lot of warning signs here that we could be setting ourselves up for kind of an intermediate peak setting up within the next 2 or 3 weeks. So let's call it cautiously optimistic that this might have some legs, but we do not have any real confirmation yet. So we're gonna incrementally step into this trade. Okay, that's the end of those. So now let's come back over here to the other custom indexes that I use. The volume ratio pushed another big number out, 18.70. one of the largest buying phases, likely because of the government trying to push through their Inflation Reduction Act. That's going to prompt another wave of spending, another stimulus. I hate to say it, folks, but depending on how this gets incrementally stuffed into our economy, it could prompt another phase of inflation, possibly by the end of this year, where the Fed may have to move a bit more aggressively. But nonetheless, this is what the data has presented. Another big buying phase last week. I would expect after the passing of the bill and the guts of the bill to actually come out, we would start to see some consolidation, some moderate accumulation. But we need to be cautious of this type of, like right here, this type of consolidation. If we get into this real narrow type of consolidation, like we saw back over here, we could be losing momentum. So right now we are not. We are gaining momentum. Traders are expecting the market to move higher, the Fed to pivot, and I think this is mostly U.S. and foreign traders expecting the U.S. market's value, particularly, to continue to grind its way higher. Technology possibly following through as well. Next, we have the U.S. to custom valuations trend index. This is an inverted chart, so it's upside down. You can see we had some follow through. This is monthly. You can see we had some follow through in July. Early here in August, we're seeing no real follow through based on valuation. So understand that we are not seeing any type of broad-based rally yet. We are in a decided downtrend. We're holding up above this support level. We're kind of in this area right over here where we get this little doji bar right here before we pulled ourselves out of this trend over 4 or 5 months and moved into an end of year rally here in 2019. We may see the same thing going in here. 1 or 2 more months of sideways trending before we pull ourselves into a Christmas rally, and that's going to depend really on consumer health, commodity prices, oil prices, gas prices, food prices, and what the Fed does. If the Fed moves aggressively and breaks the markets, this will roll right on over and start to trend downward, particularly if they start to break major assets like house prices and the real estate market. But we're seeing some support, so we're hopeful right now, cautiously hopeful. The large cap general index is moving slightly higher. This is again a monthly chart. We're not seeing any real upward direction yet, like we saw back over here, but we could be in an early stage rally phase, kind of like right over in this area, or potentially back over here in this area. Could be in an early rally phase where over the next 4 or 5 years, we could see another wave higher. And ultimately, that's what I showed you. I'll show you on another chart. Ultimately, when we take a look at the SPY, what I believe is that we're in a major wave 4 downward trend right now. So is it over yet? I'm not sure. But wave 5 is next, and wave 5 is going to be a big upward cycle trend, possibly ending in 2025, 26, or 27. So anyway, we're going to be looking at this to see if we see some strength. If we see some strength out of this, and this is the end of a wave 4 move downward, then wave 5 starts, and we are going to see the last big wave up for the next 4 or 5 years, which should be very exciting. Okay, the U.S. Global, this is custom U.S. to global index. Blue line is the U.S. stock market. Red line is the global market index. You can see the global market index is finding some support. U.S. markets are finding very strong support. We're still getting divergence here. This is the divergence I told you about, which is rather concerning. If the global markets find some weakness or start to collapse, we could see the U.S. markets roll over quite aggressively and retest these lows. We're in a broadening phase here. You can see this expanding wedge taking place here. Bigger and bigger volatility. We haven't seen anything really like this in a long while, but we could see it very easily roll over if some crisis event takes place and attempt to retest down here these lows. So this is a very big move. It's a very big risk element on the charts that people are ignoring. So we are going to play this very cautiously right now, folks. Okay, the U.S. Global Asset Index. Sorry, this is the custom Global Asset Index. It's stalling. we're seeing it stall out. Generally, the spending bill that the government just passed, and if the Fed can move into a softer, manageable transition, then we may see, like I said, the start of wave 5 taking place. But if it is incapable of managing this efficiently, we could see this kind of weaken out, flatten out, maybe move back down into this area, this 0.8, 7678, which would be a fairly moderate contraction. Look over here, 2013, we had a fairly moderate contraction. 2018 and 19, we had a big market contraction that didn't result in much in the valuation cycle. But 2015-16, which was an election year, we did have a fairly big drawdown. So now you can see here from basically end of 2020 through 2021 and 2022, we've seen a fairly big pullback, but we could see another leg down, possibly into this 0.75, 0.76 area. That would be a fairly deep low, ladies and gentlemen, potentially another 20-30% lower. Okay, and now we're at the end, I believe, here of the credit phases. Let me make sure. Nope, we've got to go to here. The custom gold cycle index. Gold has moved a little bit downward. The custom gold cycle index. This is fine. This is exactly what I was hoping for, with gold and metals moving higher. The custom gold cycle index is moving a bit lower to reconsolidate down here near this $33, $34 level. And you can see how this has happened perpetually. It rallies up, consolidates, and rallies higher. And then comes down in bases, rallies up, consolidates, rallies higher. Comes down here in bases, rallies up, consolidates, and then rallies higher. Now we're rallying up off the same level, consolidating. I would expect this to consolidate for another week or two. This is a monthly chart, so let me call that another couple of months possibly. But ultimately, metals are going to continue to melt higher. And I've done some videos on this showing you that we could see a very big move up above 4,500 to 5,500, potentially up above 10 grand for metals, for gold, between now and 2029. Okay, the real estate market, what can I say? Huge shift, just absolutely massive transitional shift. You can see here the active listing count is up near highs, starting to come down. People are pulling off of houses off the market a little bit. House prices have started to really contract. That's this blue line right here. Number of days on the market, this gray line continues to move higher. This light blue line is price reduction share year over year, is incrementally moving higher. It's at the highest levels we've seen literally in the last 6-7 years. Same thing here with median days on market. It's now, well, excuse me, we've got higher levels back over here in COVID. But since COVID, we're now at the highest levels since COVID. Price reduction count year over year is huge. It peaked out about 7-8 weeks ago at over 100%. It was actually 1.16, I believe. And now is down to 0.81, 0.82. That means that roughly 82% of all homes coming out on the market are listed right now are actually being reduced. And as you can see here, the active listing count has started to roll over a bit softer. This is likely people pulling houses off the market temporarily, or inventory shrinking. But long and short of it, ladies and gentlemen, we're starting to see a little bit of a reduction count here. Now, historically, summer months are pretty good for the market, and then we start getting into an early season around Halloween. People are trying to move before winter sets in. So we'll see what happens as this progresses. But the reality is house prices are starting to weaken. Price reductions are still high. Active listing counts are still high, weakening over the last week or two. And reduction shares are days on market are climbing. So that's a totally different market. This is basically, it used to be a seller's market. You put the house on the market and it sells in 1 or 2 days, if that. Now it's a scenario where it is really a buyer's market turning into a buyer's market, where the game at this point, ladies and gentlemen, is buyers are cautious. I talked to some people just a couple of days ago. Everybody thinks this market, especially out here in California, is wacky. They do not believe these house prices are stable. They talked to a guy who bought a house about 3.5 years ago out in near Menifee and Temecula. He said he bought it for 390,000 and is valued at 850,000 right now. That's essentially a 200%, roughly 140% increase in 2.5, 3 years. And he says there's absolutely no way these prices are going to stay this way. But again, what does he know, right? I'm just telling you, this is the biggest bubble I've ever seen, thanks to the Fed and thanks to COVID. Okay, next, the custom consumer index. Consumers are starting to re-engage a bit. I see this all the time. People are still spending. They're just being cautious about what they spend on. Inflation has really taken a bite out of their pocketbook, but they are still vacationing out here in California. They're still spending money. They're still buying jet skis. They're still having a good old time. And we'll have to see how the consumer re-engages with what the Fed is going to do next. We're seeing the consumers not engaged as much as they were back before. We're really back down here into the low 2013, 14, 15 levels back over here. We were at least, and now we're more in the 16, 17 levels, 2016, 17 levels. But we need to see how consumers really play this out. Consumers could continue to re-engage through the Christmas season, or depending on what happens, they could shift and say, nope, nope, not happening. We're not re-engaging. And remember, this chart back here, the real estate market is showing us that they're really not super engaged in real estate at the market or at the current time. Technology ratio index, this is again, FANG stocks are really soft. We are seeing a hook. This could come back up into this area here, which would prompt about a 25, 35% rally in the technology stocks. Wouldn't be enough to get back up to all-time highs, but ultimately could over time, over many years. It would be great to see technology start to rally back up out of this, but that's going to take a consumer sentiment shift. And it's going to take probably the Fed to pause a bit so that we don't have to worry about extremely high interest rates. If the Fed continues to raise interest rates, it's probably going to blow a hole in consumers and in a recovery at some point in the near future. All right. And here's my long-term SPY chart that we've gone over many, many times. So now we've covered just about everything. I do want to show you something here. Come back over here. Come back over to here and point out that I have shown you many times this longer term price cycle and the fact that we are looking at, this is the SPY, we are looking at or looking for a wave 4 bottom to start a wave 5 acceleration. And we're looking for this wave 4 bottom, wave 4 bottom. I was looking for it somewhere down here around 357 to 400. Somewhere in that area, I had drawn a number of areas saying that these could be logistical targets, but theoretically we could come all the way back down to these levels, which is the end of wave 2 right here. Now, if we see this form support at this level, and wave 4 correction, which would be a healthy correction, 25, 30% correction. And this is still moderately healthy. In some cases, almost 50%, depending on where you draw it. I'm drawing it off the COVID lows. Long and short of it, we could be starting a big wave 5 rally here. Not saying it's going to go up, the SPY is going to go up to 700, but it would certainly take out these previous highs, possibly up in the 550, 560, possibly 600 area, and that would be our next wave 5 rally. Okay, so we're looking for an end of wave 4 here. We just need to make sure that we're paying attention to what's actually happening. So let me move this over, auto scale, and come back over here to show you where we're at with this wave 4. So we're, we're up in this area. This is our rally. It broke through, started rallying higher. I expected it to stall here, which would have completed an A, B, C, D, E wave, potentially back down into this area. We are up into this resistance zone. This has been consolidated resistance off of this first A, B, C corrective wave. We need to see this really carry onward and break above this level. This would provide the next real indication that we're seeing very strong upward trending, but we have that technical divergence. We're seeing a fairly low volume rally here. You can see that rally phases when we get into a bottom. Let me go back over here to COVID. You can see we get this impulse move up with lower volume. Then we start to see accumulation come into play. So you can see we get these little buy up, like right here on these volumes. And we are not seeing that kind of a buy up move here. We did back in this area where we started to see some buying, initial buying in this phase, but now we're getting weakening volume over here, which means that we're not seeing a whole lot of real follow through to the upside for buyers. They're actually offloading a bit over here, riding the trend out, and potentially looking for weakness, which is why we have to stay cautious here. So now let's take a look at the Nasdaq, show you the same thing. It's a bit more cluttered because I have a lot of analysis on here, but we're seeing the same setup. We're seeing the A, B, C, D wave from these lows. Actually, excuse me, goes all the way back to 2000. So here we go from these lows. You can see, actually, let's go from here. Well, actually, we have to go here because this is the low. So A, B, and then we would have a C wave, which would be, this is a complex wave, folks. So this would be a C wave that goes 1, 2, and then it would go 1, 2, 3, probably 3, 4, 5 up here. And that creates our C wave. And now, because we are in this deeper downside cycle phase, we're looking at this being a E wave downward from this level down to here, potentially down to here. If it breaks lower, that would be our E wave or our fourth wave. And then from there, we would start wave 5 back to the upside. I'm going to tell you right now that wave 5 is likely going to start and really transition into full-blown trending sometime near the end of 2022, beginning of 2023. So what we have is a window somewhere in here where wave 5 is likely to start, and that would put us at potentially forming a bottom and potentially retesting it somewhere over here. So if that is correct, and if we see some sort of a weakness or price rotation, meaning coming up here, rolling over, coming back down, retesting, and then starting to move up, that would be just fine with me, because the wave 4, my cycle analysis suggests that the end of 2022 is going to be filled with a major cycle event, and we are likely going to not see any other major cycle event until 2025. So hypothetically, if you pay attention to what I'm just telling you, that means that we are going to see this area become 2022 to early 2023. So this area, the next 7 to 10 months, become very volatile, trying to hammer out a bottom. Then until 2025, over in this area, and this is going to be our bottom. The next rally phase, hypothetically, if this is the end of wave 4, and we're going to go till 2025, we're going to be moving to about like that. From 2023, somewhere around 2023, let's call it February, March, April, May, somewhere around there, likely we're going to start to form a bottom, and then we're going to have a nice solid rally phase going up until 2024, 2025, possibly 2026. And that's when volatility is really going to get a little nutty. Because at that point, we have a number of cycle phases coming in, which could send the US and global markets into some kind of a global turmoil. Okay, so we've got a lot going on here. I'm going to produce 2 more videos to try to keep you abreast of what's going on. Generally, what will happen at this point, ladies and gentlemen, if you follow my research, oil is going to weaken. Gold and silver will continue to move higher. There will be some sort of a settlement near the end of this year, some re-strengthening of consumers going forward. And then what we'll see is we'll possibly see some sort of a bottom near the end of this year or earlier, maybe early 2023, and then we're going to start to see some sort of a new rally phase coming out of it, which should be basically a soft landing. Okay, don't know what the housing market's going to do, but remember the after the 2008-2009 crisis, housing really didn't bottom until 2012, 13, 14, whereas the market started to rally quite a bit higher for the first after 2010, 11. So there was a 3-4 year window where housing prices didn't really start to accumulate all that much. We have to just wait and see how this plays out and what the Fed is going to do to try to tame inflation. The Fed wants moderate inflation, but doesn't want runaway inflation. So that's where our problem is. Okay. All right. That's it for now. I'll keep you updated. Remember, we have the new trigger in the, oh, let me show you this. This is the rotational modeling system historical backtest that I've been working on for many, many weeks. I get daily and weekly individually backtests with the application I use, but I've combined them in Excel to show you the strength of the rotational modeling system. So here we have the SPY. If you were to put $100,000 in the SPY in January 1996 and let it go, you would have ended up with about 600, sorry, let me come over here. Yeah, about $600,000 right now. It would have gone up about 600%. Whereas the rotational modeling system, combined daily weekly system, would have net resulted you over 1,600,000. That's a huge increase. Give you an example. The SPY rolled 519% higher over this, what is this, 2016, 20, when I do the math real quick, 26-year back test, 27-year back test, whereas my rotational modeling system, this one, went 1,557% higher from a starting point of 100,000. It's deployed in a 70-25 ratio. I'll explain that to you later. It only trades the SPY. It does not trade anything else. Requires 2 accounts in order to do this. Took a total of 38 trades. Okay, not overly trading. You can see here largest quarterly gain 21%, largest quarterly loss 11%, largest yearly gain 31%, your largest yearly loss is 14%, versus the S&P. Largest monthly gain, this looks like it's incorrect, 315%. That is certainly incorrect. I'll go ahead and fix that. This is the MRM quarterly performance report showing you how it's performed. These are the yearly statistics. So you can see here it did have a couple of losing years, 2012, 2007, and currently 2023, which is actually from this year, 2022. Is minus 5.39, but historically it's done extremely well. So you can see here the actual performance tracker. This is compared to the SPY. So this is the momentum, the MENT rotational modeling system compared to the SPY. It mirrored the SPY for the first five or so years, then started to outperform in 2000 when the markets turned south. That's the SPY going down, though, but rotational modeling system actually protecting capital and growing capital. Then you can see as the market turned back into bullish, it maintained that level. Then in 2007 and 8, it started to actually outperform even bigger by up to 300%. Then it maintained that level and flattened back out. There's a couple of areas here where it started to move a little bit higher, which were downward rotations in the market. Obviously, we had COVID come in. And then you can see here that we had this rotational modeling system actually outperform the SPY even stronger here just recently. So I'm going to go ahead and put this up on the website once I finish clearing it off. But this is the real value of what I delivered to you in the rotational modeling system. If you follow these triggers year after year on the SPY and the QQQ, and you do nothing but follow these triggers, this is what you're going to end up seeing if the future 15 to 20 years is similar to what we've seen here in the past. Now, can I tell you what's going to come? Yeah, I can. I can tell you that I believe we're in a wave 4 structure, looking for a downward cycle trend. Don't know where that cycle trend is going to end yet, but my analysis says it should end somewhere between, let's call it end of September, October 2022, all the way out into April, May, possibly 2023. Then we begin a big wave 5 rally to an ultimate peak. Once we get to that ultimate peak, ladies and gentlemen, we're looking at a whole different market, because once you get over here to this ultimate peak right here, a little too much. Once you get to this area, wherever this ultimate peak is, I'm drawing it somewhere possibly around 27, 28,000 for the Nasdaq. Then we start a brand new cycle trend, which is capable, understand, ladies and gentlemen, if this is a complete cycle trend on the Nasdaq, starting back here and the 2002 lows, okay, we are capable of moving into a downward cycle trend, which can blow through all of these levels, potentially coming all the way back down to retest these lows way back here and still be considered a double bottom. So this whole range right here, from wherever the top is all the way down to approximately here, becomes open target for volatility after 2026, 2027. That means that the next 25 years are going to be full of big price swings, big volatility, and huge opportunities for skilled traders. I'm not trying to scare you. I'm just trying to show you that I can actually tell you what's going on, what's likely to happen, and I have the tools to help you manage this in the future. All right, guys, follow me on Twitter, follow me on YouTube, follow my research. I'm going to be making changes to my website, and I'm going to be starting webinars very soon. Probably by the end of this month, I'll start doing the first few webinars and try to get through it, taking your questions, answering predictive modeling research, automated trading research questions, pretty much anything you want to throw at me. All right, guys, that's it. Enjoy your weekend, and we'll talk to you next week.